Hello everyone, my name is Alex Flint. I hope everyone's doing well and welcome back to my channel, A Meteorologist Chasing Fire. This channel is about being transparent about my investment portfolios, how and what I am doing to achieve fire, and showing off a few tools I have made along the way. I'm excited today to showcase which investment brokerage platform I use to help me do the following. Make a down payment on a house, a portfolio that one day will pay my mortgage, and a sink fund for the future. In today's video, I'm going to quickly review and talk about M1 Finance. M1 Finance was founded in 2015 and like Public, they are a modern and fresh brokerage platform. M1 offers various investing products like your individual and joint investing accounts. They also have custodial accounts for your kids. They also have retirement accounts like your traditional Roth and SEP IRAs, and they have crypto and trust accounts. With M1 Finance, you can open up a high yield savings account and also a checkings account if you're looking for one place to deposit your check, save, or invest your money. With M1 Finance, their high yield savings account has an interest rate of 5%, and this is also FDIC insured up to $3.75 million. Now, if you're wondering about your assets in your investment portfolios, they are also a member of SBIC that protects your assets up to $500,000. So what I've come to find is that M1 Finance is a very unique brokerage platform. With other platforms, including Fidelity, Vanguard, Charles Schwab, and also Public, you can invest anytime during the day between 9:30 and 4 p.m. With M1 Finance, you can actually only invest between two selected periods, which are 9:30 a.m. and 3:30 p.m. So what I've come to find out is that M1 Finance is not at all a day trading platform, but they are a long-term investing platform. And one of the coolest aspects of M1 Finance is that they take the concept of a portfolio and they treat it as a pie. So what they do is that M1 will break down your portfolio into slices of a pie in terms of percentages. And what that does is that it helps keep track of what stock, slice, or ETF is under overweight in your portfolio. And you can do automatic rebalances of your portfolio, and what that will do is it will sell shares to fund underweighted areas. And this principle also applies for when you fund your portfolio, and one will take your deposit and fund underweighted areas, and then ignore the slices that are overweighted. The pie is a really cool concept and a different way of setting up your investment portfolio. Instead of picking stocks or ETFs in a normal portfolio, you would make slices of a pie with those stocks and ETFs, which is pretty fun. You can pick individual stocks and ETFs to make your pie, or you can create different sector slices, including healthcare, technology, consumer staples, or focus on dividend/growth stocks. When you first start out with M1, you'll be asked to make the pie, and this is where you pick out your stocks, ETFs, or slices to create the pie. Then you allocate your portfolio based on percentages as seen in the visual and what percentages you want. And then when you deposit your money, M1 will automatically split out the money based on your targeted percentages and fund the portfolio accordingly. Investing in the stock market, your slices, ETFs, or stocks, they will go up and they will go down. It's just how it goes in the market. Typically, you have to manage your set target allocations, but however, with M1, this tracks it for you. As you can see here in the top right, the slice shrinks, and then with time, the next slice in the bottom right increases in size. But when you fund your portfolio, the next time, M1 can see that one of your slices is underweight, and it will fund the slice so that your portfolio is back to your set target allocation, which is pretty damn smart and cool. And seriously, this is vital down the road, as eventually one of your slices or stocks or ETFs will outperform the other parts of your portfolio. And from experience, it is one of the hardest and tedious things to do, which is to manually maintain the allocation of your portfolio. And rebalancing yearly or whatever you do typically causes a tax event. However, with M1 Finance, they do the heavy lifting for you, and all you have to do is deposit the money, and M1 Finance does the rest, including the maintenance of your portfolio. And that typically comes with a fee, as I've learned with my 401k portfolio, but that's another story. Now, I will say there is a bit of a learning curve with M1. Starting off, the pies are a bit confusing when I first started. I did not understand the allocation, picking different stocks, ETFs, making slices, how to fund them, how M1 funds those, the under and overweighted thing. It all took a bit of while to figure out. And also, if you want to make changes, including move around your stocks or ETFs between different slices, that takes a few minutes to finagle. But I'm speaking strictly using this on doing this on the app, but the website might be easier. But if you're curious about how the pies work, I will leave this link and others in the description. But otherwise, I've invested with M1 since November 2022, and I have quite enjoyed the experience. It is so great to not manually invest, not having to manually maintain the allocations in my portfolio. They will even take the dividends you earn to fund whatever areas in your portfolio are underweighted. And it is such a smart way to invest that has incentives to invest for the long term and not to day trade, which I like and appreciate. So, with that said, enough of me ranting. Let's get into the 3 portfolios that I have with M1. As many of us in the range of 20 to 30 are thinking about buying a house, we find ourselves in a pickle of a situation. Interest rates are higher currently, but as I have heard from others older than me, oh, you can refinance, which is fine. But personally, I'd rather not take the chance or make the choice when I don't have to. The real issue starts with the price of housing and living wages. And for example, we're looking at the last 4 years. Housing since 2020, using the median prices of houses sold, has increased by 116%. And I know for a damn fact that your wages have not increased at the same rate. So the question is, how do you even accumulate enough to afford a down payment on a house? Right now, my wife and I are looking at 20% down payment to avoid PMI. But we understand as first-time house buyers, we don't have to do this. But for us, avoiding PMI over the long run makes us feel better. The fact is, to have a 20% down payment in the Fairfax area, you need at least $100,000, which is a lot of money. So what we are doing is a split between investing in the market but putting money into a high yield savings account. The split was to ensure that we take advantage of the market but save up for emergencies and for what comes after buying a home. So that's where the portfolio I named, the Funds for Fun, comes into play. We're using this portfolio to accelerate the accumulation phase, right? We're not putting all of our money into a savings account. And I think this is going to drive and help us make a down payment on a house in the next 2 to 3 years. So the fund follows the core satellite method with 46% of the portfolio allocated to ETFs and 54% to growth stocks. My rule of thumb is that no stock is weighted above 5% and it's spread out between technology, industrial, finance, consumer discretionary, and one healthcare stock. So far, the portfolio has done really well. I feel really lucky just to have this kind of money return rate. The portfolio as of March 30th has a money return rate of 48.1% since November of 2022. So diving into the portfolio, the core, which I call the ETF core, the core is made up of 2 ETFs, the Vanguard Technology ETF, or VGT for short, and the NASDAQ QQQ. So the VGT is a highly regarded technology ETF that mainly focuses on your trillion-dollar market cap tech stocks like Microsoft, Apple, and one of the hot stocks of the year being NVIDIA. So the NASDAQ QQQ primarily focuses on technology stocks, with its top holdings being again Microsoft, Apple, and NVIDIA, but also has one of your favorite places to shop online, Amazon. So the QQQ also focuses on high-quality growth stocks, including, for example, Google, Tesla, and Meta. So I've come to find that both of these are excellent core ETFs if you want to add growth to your portfolio, for example, in a retirement account. And currently, the slice has a money-weighted return rate of 40.57% since November 2022. So moving on to the next slice. The next slice in the Funds for Fun portfolio is the financial healthcare, which I've allocated at 22%. So this slice is made up of what I think are really strong companies with, I think, wide moats and for the most part are compounding machines while not being closely connected to the economic cycles for the most part again. So in this slice, I have S&P Global, Visa, Berkshire Hathaway, MSCI Incorporated, United Healthcare Group, and Moody's Corp. So a lot of these companies in here you might not recognize, except for maybe Visa, United Healthcare Group, and Berkshire Hathaway, if you're a nerd like me. But in another video, I will go into more detail about why I picked these stocks. and more of the reasons why I did. So far, the slice has done pretty well. It has a money weighted return rate of 15.79% since around June 2023. The next slice in the portfolio is the technology slice, allocated at 12%. So this slice is pretty simple. There's only 3 companies. Um, Again, 2 of them we might not have ever really recognized or just really thought about, but one is Broadcom, which, if you're a stock nerd, this has completely taken off and is one of the semiconductors stocks like Nvidia. But FICO and Intuit is so Intuit is your TurboTax. That's how you do your taxes, and the FICO is, or Fair Exit Corp is your FICO score for your credit card. This slice has done remarkably well in the last 8 months, and has a money weighted return rate of 52.2%, which is insane. So I'm pretty happy with this slice and how it's performed. So for the next slice, we have industrials, allocated at 11%. So industrials are not like your technology stocks. They are more what I call steady eddy sector, and they're really good for consistent growth. I mean, they're not going to be like Meta or Nvidia that have like quadrupled or whatever in the last year, but they're good for consistent growth. So far, the money weighted return rate is 52.39%, which I think is a lie, because that number there for the company I have been sliced, Cintas, was not this high a few days ago. But whatever. So the companies I have in this slice is Cintas, Northrop Grumman, O'Reilly Automotive. This is more of a consumer discretionary stock, but when I was making this portfolio, I didn't realize that, so it's stuck here. And the last one being Old Dominion Freight Line. So far, this slice has done pretty well. I'm pretty happy. Again, not really tied down to most economic sectors. I mean, economic cycles, and they are all good, solid companies to have. So for the last slice that I'll go into in my funds for fun portfolio is consumer discretionary, allocated at 9%. So this slice has been the most volatile and has changed the most out of all my slices. I've had 2 or 3 stocks in here that just didn't suit me fancy, including Starbucks and Dollar General. I don't typically trade a lot. I try to pick really good companies and stay with them as long as possible. But if it doesn't fit my values, or it doesn't fit my goal, they get booted out. So far, the slice has done pretty well. It has a market weighted return rate since June of 2023 of 24.8%, and my high flyers in this slice is Amazon and Texas Roadhouse, and Ulta and Wingstop have done really well so far. Wingstop is more of a kind of a gamble. I know they sell wings, but it was more based on statistics and numbers. But the stock kind of reminded me of Chipotle, so I'm pretty excited to see where the stock will go. And with that, that is a quick look at my funds for fun portfolio. Overall, I am very happy with the portfolio and the stocks and ETFs I have in here. And for the most part, I'm pretty damn confident this portfolio will help me make a down payment on a house, all things considered. So you may be wondering why I don't have certain stocks in here, like Nvidia or Meta, Netflix, Google. And the truth is I don't like high flashy stocks like that. I consider them high flashy, but stock market is mostly based on human emotions, and how they feel. For example, Meta tanked. They were at $90, I think, a year or 2 ago, and now they're at like what, 400. The same for Netflix. Nvidia has taken off because semiconductor chips and AI is a thing right now. So what I try to do in this portfolio is pick really good stocks that are not tied to emotions for the most part, or the emotions of the stock market. And I try to pick stocks that are steady eddy, kind of like industrials. So I hope you enjoyed this. I always think it's so cool kind of to peek underneath the hood, see what people are, what their portfolio is made up, why did they pick certain stocks. So I hope you enjoyed that as well. So the next few parts of this video, I'm going to go into the 2 other investment portfolios I have in one. So I'll see you over there in a second. So the next portfolio that I have within one is called the mortgage fund. There's more or less a story with this one. So my wife and I are thinking about how to retire early or to reach, financial independence by doing some maths. Uh, I have realized that to reach FI or RE, we need growth, right? So my wife and I would love to retire purely on dividends alone, but unless we get paid more than 300 grand, we will have to rely on growth ETFs. So that brings us to this portfolio, right? What we call the mortgage fund. This portfolio would be used to pay for part of our living expenses in the future, like the mortgage fund, given the title, and our dividends can cover the rest of our living costs. So there's what we call the simple path of wealth, the dividend simple path to wealth. I call this the hybrid simple path to wealth, using dividends and growth ETFs to fund your living expenses. So this portfolio is super simple. There's 3 ETFs. So what we have in here is the Nasdaq 100 QQQ, similar to the QQQ, but just a little bit different. The next we have the Spider Technology Sector ETF, and the last one is the Charles Schwab's U.S. Large Cap Growth ETF. So these ETFs focus purely on growth and mostly technology, and so far this portfolio has done pretty well. It has a 24.8% return money weighted return rate since September 2023. And I think it's good. I think this is a great portfolio. It's very simple. I don't want to make it too complicated. It's just 3 ETFs. I fund them, uh, you know, every week, kind of like my dividend growth investing portfolio. And lastly, the allocation. So 40% is allocated to QQQM and XLK, and then 20% to SCHG. So yeah, that's just a quick rundown of this portfolio, and so we have one more to go. So for the last portfolio, my third portfolio with M1 is what I call a sync fund. There's no purpose for this portfolio. It is for a place for leftover money or cash that I have that I can throw in here. So you may be wondering, what is a sync fund? So a sync fund could be for a nice vacation in the future, a down payment on a car, or money for your parents if they, have struggled with saving up for retirement. There's really no purpose on a sync fund. It's just where you can sink your money into an account, and for me, it's again a growth oriented account. So like the mortgage fund, I keep it really simple. There's only 3 funds. The 3 ETFs in this account is VGT again. I have the Spider Portfolio S&P 500 Growth ETF, similar to SCHG, but just a little bit different, and the renowned famous Vanguard Total Stock Index. So I just funded this portfolio. I had me and my wife had a large tax refund from getting married, so I threw some money in here, and so far it only has a 1.8% money weighted return rate. So far, so yeah, that's the sync fund. So again, to kind of go into the sync fund, my future purposes with this portfolio is that maybe in the next 3 to 5 years, my wife and I want to go on a really nice vacation, so I can start saving up money, via savings account or this investment account, and we can use that to fund our vacation to Hawaii or Japan, for example. And on that note, that's all I have. Thank you so much for sticking around and watching me rant about M1 Finance and my 3 portfolios. If you like the content, please like, subscribe, and send this to your fellow Gen Zers and young millennials who aren't sure about investing. I sure as hell didn't 3 years ago, so I just want to share what I know with everyone else. Overall, I really do like M1 Finance and its smart features. Again, it takes on the burden of self-managing your portfolio and does it for free, which is again a wild thing that I know because my platform that manages my 401k fees me like crazy each month for just doing the basics. So if you're interested in investing for the long term and want a brokerage platform that pretty much does it all, check out the link below. By the way, I am not a chartered financial advisor or planner. I'm trying to be in the future. But for now, I'm just a meteorologist who likes the maths and finance part of investing. So in the next video, I will go more into depth of the mortgage fund portfolio and show you what I call the FIRE dashboard and the tool I use to help me forecast my FIRE date. So that's all I had. I'll see you next time. Have a good one.